Good opening for the market, 30 points higher on the index. The mid-caps are up almost about 200 odd points as well.
Markets absolutely flat. The Nifty is currently blinking red and green.
EBITDA margins have come in at 23.1%, which is a sharp beat as per our expectations.
All three parameters, revenues, margins, as well as profits, are slightly lower than what the street was estimating.
I think the action is not in the Nifty or in the Sensex. It's all in these individual stocks, and we've been hit by a barrage of earnings.
Absolutely flat, 6 to 7 points up on the Nifty. That's all that you've got. But don't look at the index. It's not an index kind of day. It's really about individual stocks, whether it's earnings or news, because you've got pretty severe result reactions.
Well, it was indeed about individual stocks for the markets. It was absolutely flat. The Nifty somehow managed to eke out some gains by closed above that 19,681 mark, yet again holding on to that zone of 19,650 to 19,700 as an important support. For the broader markets, it was another different story. We had the mid-cap index higher by about 0.4%. This is markets today, where we track 6 hours of trade and 5 trading actions. And let's talk about those 5 headlines itself. Sensex and the Nifty end marginally in the red after a range-bound session. Nifty ekes out some gains. The mid-caps buck the trend with the index gaining nearly 150 points. Tata Steel's India business delivers a healthy performance, but its European business continues to struggle. CEO TV Narendran bets on organic growth, says Tata Steel is not keen on acquiring steel assets of Vedanta or NMDC. Tata Motors reports a 41% jump in the first quarter revenue. Jaguar Land Rover sales rise 57%. Bajaj Auto reports a 29% jump in revenue and 42% rise in profits for the first quarter. Margins also expand to 19%, but slightly below expectations. We had numbers coming in from Asian Paints, largely meeting estimates in the first quarter, even as revenue growth of 7% is just shy of estimates. Double-digit volume growth offsets decline in international revenue. Stock declines by 4%. Market regulator SEBI flags off various reforms that are in the pipeline. Chairperson Madhabi Puri Booth says it is in talks with stakeholders to bring in instantaneous settlement in the stock markets. Adds that measures taken so far have saved 3,500 crore rupees per year for investors. Also promises new delisting regulations soon. Let's talk about the first headline then today. It was all about individual stocks in the market because it was a range-bound session. The Nifty held on to that 19,600 mark. That was the low of the day, but thereafter saw a big recovery. So if you just take a look at the intraday chart of the Nifty, you would see it opening higher, then seeing a big dip, and from there was a near V-shaped recovery as well. It ended the session mildly below that 19,700 mark, but a slight positive bias. Metals, they were the star performers, with that index soaring close to 3%, while mid-caps outperformed the blue chips, where banks underperformed. We have Surabhi joining in with the market highlights. Surabhi.
What an extremely range-bound day for the market, with the Nifty barely moving. Finally ended with a 3-point up move and a close below the 19,700 handle. It's all about individual stocks, earnings, individual news flow that's driving sharp reactions, and I'll get to that. The mid-cap index actually fared slightly better there towards the second half. Around 3 o'clock or so, we had a move, and the gain was almost 0.5%. But large caps are seeing very interesting reaction to numbers. For instance, Asian Paints really stands out today. Numbers were more or less in line, but the stock sold off 4%. ITC saw further pressure after the hotel demerger announcement. ITC has now lost over 5% in 2 days back to back. Bajaj Auto slightly subdued earnings, and the stock has already run up, so there was some profit taking over there. But on the other hand, TVS Motors, the market liked the brokerage commentary that came out after numbers today, and the stock managed a 5% up move for itself. Jubilant Foods numbers were well received by the market. The like-for-like sales growth was better than anticipated, so we saw some green on that stock. But largely speaking, it's, again, as I said, it's very, very company-specific. In terms of a sector, if there was one move today, it has to be metals. All this talk of additional stimulus measures for the property market in China that really worked wonders for the metal side of the market. So Hindalco 4%, Tata Steel, JSW Steel, all these stocks were flying high. Banks were directionless, so the bank Nifties ended with minor cuts. You had an SBI, Axis dragging things down, HDFC Bank up. So, zero-sum game there on banks in terms of direction. The Adani Group did have a very interesting rally. It started at around 3 o'clock in the afternoon, and it spread through the entire group. Adani Ports, Power, Transmission, even ACC and Ambuja. So that was an interesting, pocket of action in the market. Overall, things are expected to remain very, very stock-specific as more earnings come in. Tomorrow we'll react to L&T, there's Bajaj Finance, a whole host of large-cap numbers lined up. So until we get the Fed reaction, which is on Thursday, the action is largely expected to be very, very company and stock-specific.
company and stock specific. Indeed, we did get a bunch of numbers post-market as well. But let's talk about market itself. Andrew Holland, the Chief Executive Officer at Avendus Alternate Strategies, believes that market is looking overbought right now, and there are signs of negative earnings coming in a few sectors as well, or rather overheated performance, and as a result of which downgrades in earnings. Let's hear him out.
I think the markets were looking overbought. And it doesn't take, it takes a little bit of, one or two kind of, not poor results, but, results in line, or some negativity around certain sectors. And it just, takes a froth away from the market. So I'm okay with markets kind of drifting for a while now, until we get the next catalyst. The next catalyst is really going to be the kind of earnings upgrades, which we're going to start seeing from the second half of this fiscal going into 2024.
The second headline now, and it was the metals pack which did extremely well. In that, we had Tata Steel, which rallied 3% on the back of a big beat coming in their net profit itself. The steel major has reported consolidated net profit of over 520 crore rupees. This was an expectation of 160 crore rupees itself. However, revenues came in much lower than street estimates. This because of lower than expected realizations and weakness in the European business. For Tata Motors and all the metals pack, what happens in China is important. Nigel joins in with the key highlights of Tata Steel and the metals pack itself. Nigel.
Well, that's right. Tata Steel's numbers were better than expected, and hopes of a bigger stimulus coming in from China. That's what fueled the stock price move in today's trading session. But let's run you through the big takeaways. The India business, while the EBITDA per ton appeared it was much better, coming in around 16,000 rupees per ton. But actually, you need to adjust that number. And adjusted for that 2,000 rupees of other income, where it comes down to around 14,000 rupees per ton, which is still better than the 13,500 that we were working with. Europe, though, continues to be the pain point. It continues to report losses of more than $90 on a per ton basis. The debt for the past quarter went up by close to 3,500 crores because of capex spend of around 4,100 crores. The management, though, they reiterated the fact that they want to go ahead and try to reduce debt by around $1 billion on a per annum basis. It'll be interesting to see whether or not they can do anything close to that number, because in the first quarter itself, the debt number has gone up by 4,000 crores approximately. Now, a few more big takeaways from what the management had to tell us here on CNBC-TV18. They said for the coming quarter, prices will be lower, both in India as well as in Europe. In India, it will be lower by close to around 3,100 rupees per ton, while in Europe, it will be lower by close to around 40 euros on a per ton basis. Coking coal costs for the past quarter were up by $10 per ton. But in the coming quarter, they're likely to fall by close to around $50 per ton, telling you they'll get some benefit of the falling coking coal prices. The EBITDA per ton, though, will remain more or less flattish in quarter 2 in comparison to quarter 1. And the UK business, well, they continue to engage with the UK government, and they are hoping that there will be some resolution that comes out of them. And finally, they clarified that their bigger focus is on organic growth, and they want to scale up the existing capacities rather than bid for assets like NMDC Steel as well as Vedanta Steel's assets. So those are the big takeaways from Tata Steel. In fact, let's hear out what the management had to tell us earlier today.
Q2 will be about 3,100 rupees per ton lower than Q1 in India, and maybe about 35 to 40 euros per ton lower in Europe compared to Q1. Last quarter, the consumption cost of coking coal was about $10 higher, which is what we had guided, both in Europe and India. Europe was a bit less, India was a bit more, but broadly around $10 per ton higher consumption cost in Q1 compared to Q4. If you look at it from a spread point of view, it's obviously going to be similar or slightly better. But I think there are costs beyond coal and iron ore and the steel price, and those are the costs that we are watching. So now we have both Neelachal and Usha Martin, and in Neelachal we can build a 10 million ton long products complex. So we are well positioned to grow in long products without having to acquire any new assets. And NMDC, like I said, we were not really keen on it because, again, between Kalinganagar and Bhushan, we can add another 15 million tons at least.
All right, let's move on and let's talk about the other headline that we're watching out for. Bajaj Auto reported a strong set of numbers in the first quarter. The company recorded its highest ever quarterly EBITDA of nearly 2,000 crore rupees. Meanwhile, Tata Motors reported a beat across all parameters. Post numbers, the revenues jumped 42% year on year. But importantly, they announced the closure of Tata Motors DVR, extinguishing them by replacing them with Tata Motors itself. So that would be an important news to watch out for tomorrow as well. Sonia Shenoy joins in with the details of Tata Motors first. Sonia.
Well, thanks a lot for that. It was a very strong showing from the Jaguar Land Rover business, which aided the overall numbers as well. A big beat on the numbers, both on the top line as well as the bottom line for Jaguar Land Rover. Consolidated business revenues went up over 42%. The margins have improved 700 basis points, coming in at 14.4%. And it's a turnaround quarter for Tata Motors. On a year-on-year basis, the company posted a net profit of 3,200 crores compared to a loss of 5,000 crores same time last year. A large portion of this was due to Jaguar Land Rover, where the revenues went up 57%. The EBITDA went up 960 basis points year-on-year, coming in at 16.3%, and the EBIT margins have improved to 8.6% versus 6.3% last quarter. Not just that, the net debt for JLR has also come down to £2.5 billion as on the 30th of June. Now, the company says they expect the demand to sequentially improve in FY24 for the CV business, and the net automotive debt has reduced to 41,700 crores. But the important bit for Tata Motors really is that now if you are a DVR shareholder, then for 10 DVR shares that you hold, you will get 7 Tata Motors shares. So there will no more be Tata Motors DVR. It will all be, converted into Tata Motors shares, which is a big positive for Tata Motors shareholders.
All right, Sonia, thanks a lot for that. In fact, the important part here would be the DVR shares have been valued at a 23% to its closing price today. So to that extent, we will see an adjustment tomorrow. Likely big positive opening for DVR tomorrow and lower opening for Tata Motors just by virtue of this technical adjustment. But Bajaj Auto's first quarter numbers, Sonia, how were they?
Well, it was a strong set of numbers for Bajaj Auto, but slightly below what the street was estimating. The company hit a record high EBITDA performance, coming in at 1,954 crores. The margins came in at 19% versus a poll of 19.6%, and that was a growth of almost 280 basis points on a year-on-year basis. Now, the company has added 2,000 crores of free cash flow during the quarter, and the management has said that double-digit volume growth is something that will continue, and they have seen an improvement in exports that will aid the margins going ahead as well. On the revenue front, it was a growth of almost 30% that Bajaj Auto saw, an EBITDA growth of 50.6%, while the margins have improved to 19% versus 16.2% same time last year. Also, the profits for Bajaj Auto have gone up 42% on a year-on-year basis.
All right, Sonia, thanks a lot for that. With that, we'll slip into a short break, come back and talk about all the other headlines that we're tracking today. Welcome back. You're watching us here on Markets Today, the show where we talk about all that happened during the course of the trading session. The other one was Asian Paints that lost over 4%, and this despite an inline set of numbers for the first quarter. So let's tell you about the numbers itself. It was an operationally strong quarter. The company exercised its execution muscle for good growth. The EBITDA was a beat despite a 41 crore one-off that the company had reversed in their employee expenses as well. Let's talk about the numbers. Volume growth at 10.1%. This compares with the CNBC-TV18 poll of 10 to 12%, largely in line. Margins 23.1%. This against expectations of 21.2%, and the net profit beating estimates as well. The only thing that could have been slightly better was the revenues that came in at 9182 crores versus expectations of 9350 odd crores. And that's largely because of a couple of factors. Maybe the company passed on a little more in terms of price hike to spur consumption demand. There was weakness in the international business, and there was weakness in the smaller parts of their business. That's bath fittings as well as kitchen business as well. The question is, what lies ahead after this sharp expansion in margins and performance as well? Crude prices are at 3-month high, so going forward, where the margins sustain is something we'll have to watch out for. Competition is rising in the paint sector, and the stock actually ended at the low point of trade largely because it went into numbers when it was near record high, trading at a 66 times 1-year forward earnings. So that's something that limited the upside on Asian Paints. Now going forward, the management is confident about a robust festive season demand ahead. So that is something we'll have to watch out for. The other stock that was in focus was Jubilant FoodWorks. Rallied about 2%. The operators Domino's Pizza reported a mixed first quarter. The reason why the numbers were mixed was because one, on the top line, it was a mildly below expectations, so to say, or rather above expectations, 34 crores in terms of the revenue reported versus a poll of 1,312 odd crores. The EBITDA was largely in line. The net profit was impacted by an exceptional loss of close to around 40.8 crores. This compares with a one-off of 11.5 odd crores itself. The operational performance was stable, and the like-for-like sales growth per store actually declined much lower than what the street was fearing, 2 to 3% versus a decline of 1.5% that the company reported. The other thing that the street liked was that the company opened about 23 Domino's stores during the quarter. They were working with a number of 45 to 50 stores. So lower stores opening means that going forward they would see some moderation in like for like. The value addition that the company has done with regards to entering lower priced pizza points is something that we'll have to watch out for going forward, and also them having expanded their exposure in Popeyes and Hong's Kitchen, the other verticals, is something we'll be watching out for. But let's move on, because the market regulator SEBI is working on a slew of reforms for the Indian capital market, starting with instantaneous settlement. This comes just 5 months after it announced a shift to T+1 settlement system. Yash joins in. Yash, seems like if this were to go through, everything that you would buy would immediately reflect a UPI, so to say, for share markets.
Well, that's correct. A lot more action expected and volumes expected, particularly if this goes through. And this came from a completely off-course briefing from market regulator SEBI. But the insights are very crucial in terms of what the market regulator has planned as far as the reforms pipeline is concerned. The first one, we'll start with the most interesting one, that is instantaneous settlement. Market regulator SEBI said that they are looking at something which is called an instantaneous or intraday settlement cycle, where if a stock is purchased on, let's say, Monday, the settlement for that stock, which means the debit from the account, will happen on the same day. If a stock is sold on Monday, the settlement, which means the credit to the account, will happen on the same day itself. Now, of course, this will give traders far larger opportunities to shift from one stock to the other on the same day itself, hence pushing the volumes on the exchanges. Also, the biggest positive will be that there would be no margin money which will be required to be kept with the broker. The next important thing which market regulator SEBI spoke about was the review of delisting regulation. SEBI's come across many instances of price manipulation before the company announces its delisting, and hence one of the suggestions which market regulator SEBI could consider would be to have a fixed price from the management of the company, in terms of delisting of shares. There was also trading regulations expected for perpetual insiders, and also standard disclosure regime which market regulator SEBI could look to introduce.
So 3,500 crores of the interest value of funds which have been released into the system on account of the improvements that we have brought into the ecosystem through the use of technology. This is on an annual basis. One of the things that we think is not very far off is even instantaneous settlement on the stock exchange. We are currently working on that. We are engaged with the ecosystem, and we believe that in the not very far future, we will have a mechanism which will facilitate instantaneous settlement.
All right, with that, let's move on to the fifth big headline. Another set of numbers coming in post markets. L&T, that's the one that reported a good first quarter, even though margins were slightly below expectations. In fact, we do have with us Vivek Iyer with all the details there. Vivek.
Well, L&T has just come out with its results. On the face of it, a very good set of numbers, very strong top-line growth. And what's actually going to surprise the street very positively is the very strong ordering intake that the company has gone ahead and given to the exchanges. So first, let's have a look at the headline numbers themselves. Revenues much above what our poll was, 47,882 versus our poll of just around 40,550 crore. So a significant beat coming in as far as the top line is concerned. Management says that the top line growth was actually aided by execution of healthy opening order book as far as the projects as well as the manufacturing portfolio is concerned. Now coming to the core EBITDA is coming in at close to 4,869 crore, above our poll of close to 4,577 crore. Margins, however, are a miss, and that is going to be a sore point. Analysts, however, did pencil in and did caution that margin recovery could be back-ended towards the second half, and that seems to be playing out as far as L&T's core margins are concerned. Profitability too above the poll, coming in close to 2,493 crore versus our estimate of 2,150 crore. Now the key point, as far as this particular result was concerned, was the buyback. So it's a very large buyback. 3,000 rupees per share is what the management has given as far as the buyback price is concerned, and the size of the buyback is close to 10,000 crore. Apart from that, the company has also given a special dividend of 6 rupees a share as far as the FY23 is concerned. And lastly, the order wins of 65,520 crore at the group level is up almost 57% on a year-on-year basis, with 40% of orders coming in from the international book, which is quite strong.
All right, Vivek, thanks a lot for that. So good numbers coming in from L&T. So that will be a bit of a support tomorrow for the markets. With that, we are out of time on this edition of Markets Today. You stay tuned to CNBC TV 18. Thank you for watching.